Hello and welcome to Earnings Central live from the CNBC TV 18 Motilal Oswal studio. I'm Ritu Singh. Now, HDFC Bank, the country's largest private lender, reported its fourth quarter numbers, beating street estimates with profits up 6.7% and net interest income up about 10.3% over the previous year. Asset quality improved while the net interest margin on total assets came in at a seven-quarter high, albeit a slight decline from the previous quarter. Abhishek Kothari is here with more on the numbers.
Well, HDFC Bank reported its Q4 FY25 numbers. The numbers were strong, especially on the core operating profit growth, which was up more than 20% YOY and about 4.9% on a sequential basis. So take a look at the net interest margin on total assets. It's at seven-quarter high of about 3.54% versus 3.43% in the previous quarter. Now, this has a one-off of about 7 to 8 basis points with respect to net interest margin. So even then, it comes down to 3.46% versus 3.43% in the previous quarter. Analysts were estimating a decline in net interest margin. However, they have expanded without including even the one-off income over there. Take a look at the cost to income ratio. It's at four-quarter low of 39.8% versus 40.6% in the previous quarter. The annualized quarterly slippage ratio is at five-quarter low, coming in at 1.15% versus 1.4% in the previous quarter. Overall, the slippages have declined nearly 15% on a quarter-on-quarter basis, which is heartening to see. The asset quality remains impeccable and continues to improve with one of the best in the industry. Gross NPA ratio is at 1.3% versus 1.4% in the previous quarter. The net NPA ratio has also declined by 3 basis points on a sequential basis. The other key highlights being the net interest income growth is about 10.3% YOY and about 4.6% sequentially. They have been able to command better yield because the loan growth is at just 5.5% YOY and about 4% sequentially. The OPEX has remained under control for them, which has helped the operating profit growth. OPEX have declined by 2.3% YOY and grown by only 2.6% quarter-on-quarter. Overall, the provisions are down 76.5% YOY, but they have increased by just 1.2% sequentially. So PAT is a growth of 6.7% YOY and about 5.3% quarter-on-quarter. Overall, good numbers coming in from HDFC Bank, especially on the core operating profit growth. Back to you.
Well, do stay on. Let's also talk about ICICI Bank that has also beat street estimates with the 18% rise in profits and 11% increase in NII. Asset quality there as well saw an improvement. Abhishek, tell us more.
Mixed set of numbers coming in from ICICI Bank, weak with respect to business momentum that you are seeing for them, while the PNL continues to remain strong for them. Take a look at the deposit growth, 14% YOY and about 5.9% sequentially. YOY, it's the weakest deposit growth that you are seeing in last 8 quarters. Now, advances growth is at 13.3% YOY and just 2.1% quarter-on-quarter. So YOY, this 13.3% growth is the weakest that you are seeing in last 17 quarters, and sequentially, it's one of the weakest loan growth that you are seeing in last 15 quarters. So loan growth remains very weak for them compared to their historical numbers. The net interest margin is at five-quarter high of 4.41% versus 4.25%. The core operating profit growth is at five-quarter high of 13.7% YOY and 5.5% sequentially. The quarterly annualized slippage ratio, that's heartening to see. It's a 17-quarter low of 1.5% versus 1.85% in the previous quarter. Their asset quality continues to improve and remains one of the best that you are seeing in last 10 years or even more. Gross NPA ratio down to 1.67% versus 1.96% in the previous quarter. Net NPA ratio down to 0.39% versus 0.42% in the previous quarter. So asset quality and PNL gets a thumbs up, while weak business momentum or weak loan growth actually impacts the balance sheet. Back to you.
All right, a mixed bag for ICICI Bank and a strong one for HDFC Bank. But to decode these fourth quarter numbers, we are now joined by Asutosh Mishra, a banking analyst at Ashika stock. We'll also have other analysts joining in just a bit. Ashutosh, thanks very much for being with us here. Let's quickly start with HDFC Bank. Your first reading, nothing much to complain there.
Yeah, there is nothing much to complain. The business growth momentum is very good, and even on asset quality and profitability metrics looks quite great. What we need to really look forward from here is that how they will navigate on the interest rate cut and what will be the impact on their portfolio, and how they are going to play out this whole interest rate cut, especially on a net interest income front over the next 1 year period. That will be the key things which I will be watching. I will be looking for the management interactions in today.
Well, Ashutosh, one of the key highlights that came in today morning was HDFC Bank cutting its term deposit rate as well. So overall, while interest rate will decline, from the banking sector perspective, but what banks have done in this quarter is that they are reducing their cost of funds by cutting deposit rates, especially on the saving deposits as well as term deposits. What's your take with respect to, net interest margin trajectory for the banking sector in a declining interest rate scenario?
Yeah, given, no, you are absolutely right. The way they have cut their interest rate on saving bank deposit as well as term deposit both. So, and proportion of these deposits are relatively healthy compared to the many smaller banks. So, in that scenario, I clearly looked at a large bank with relatively higher saving proportion, and if they cut the saving bank deposit rate, they will be able to manage the so much better compared to many other banks. But still, we need to take into account that approx 50% of these loans are linked to the EBLR, and in the as we are expecting more rate cuts to come in, given the global scenario is, so it will be a little bit of tougher time for the banks in the first 6 months of the year, and because the deposit repricing will catch up in the second part of the year. The first 6 months, probably we may see some pressure on the NIMs, and in the latter part, it will be very win-win situation for them.
Asutosh, do stay on. We also have Prakash Diwan, market expert, joining in now. Prakash, both ICICI and HDFC Bank numbers, your quick thoughts before we get into details.
No, so I think, let me speak about ICICI because while there's distinctly a little bit of a pause in the kind of lending growth, as a percentage, retail is kind of making up for what corporate loans is kind of let up. So, whatever they've missed out on corporate loan book, the retail loan book is filling in. And that's quite healthy because the pricing becomes much more better. The cost of funds, as Asutosh was also explaining, subsequently forward-looking, progressively will keep coming down. And that probably is a way to grow the lending on the corporate side. So it's a very balanced kind of if you really ask me the number, it's not disappointing at all. In fact, the market will like this because it sets the base for growth in the next 4-6 quarters. So that's essentially what these numbers tell you.
Well, Prakash, with respect to, stock price correction that we have seen for the banking industry and, Nifty Bank actually underperforming the overall overall market in the last couple of years, do these numbers look good enough for re-rating of banking stocks going ahead?
Certainly, Abhishek. See, look, we might have seen the bank Nifty underperform the broader market, the Nifty, largely. But the way the catch-up has happened, in fact, this rally, if I can call it, in the last month or so post-March, the lows in March, this is led by the banking heavyweights. And it's no surprise that it's first the private sector heavyweights, then it'll probably be the PSU heavyweights, then it'll be the private sector smaller companies, smaller banks which will participate. And this could mean that the bank Nifty can be in a slightly different orbit and lead the market from that sense. For the next, 1,000, 2,000 points on the Nifty, you'll probably see the bank Nifty do much better. So that's the way the setup is saying. And the banks, everybody was, looking at banks contributing and, things turning around. And it's very domestic in terms of orientation at this point in time. All the growth that you are expecting is more from domestic factors, nothing to do with the issues and the mess that is happening on the overseas queues. So I think it's very well poised, and I do agree. Banking will lead the next significant up move in the markets as well.
Well, Ashutosh, one key number to track was the ICICI Bank's loan growth number, a multi-quarter low with respect to the growth rate that you are seeing both YOY and quarter-on-quarter for the bank. Are you worried that the bank is going cautious with respect to the credit deposit ratio, or, the deposit momentum is such high that they are not able to keep the pace of loan growth with that?
I think the second will be more true, that their focus was more toward the deposit momentum, and because of that, there is some lag on the loan part of it. But given their track record, it's not any major concern. They will be able to catch up it very quickly in the first half of the year itself.
Prakash, my one question to you, there was a fear that till Q4 FY25, at least the net interest margin trajectory will be on the lower side or declining trend. But what we have seen with all the banking numbers that have come out today, HDFC Bank or ICICI Bank or Yes Bank, the net interest margin trajectory is improving and slippages have declined massively, which has led to massive improvement in their asset quality as well. Would these comfort investors with respect to how the balance sheet of banks are moving?
Oh, absolutely. See, the bank balance sheet, let's take the large four, which is HDFC, ICICI, Axis and Kotak. Their balance sheets have never been as strong. And this is without any impending incremental NPAs that could get reported, because there's been no credit growth which is circumspect in the last 2 years, right? I mean, we've not seen any splurging of loans by any of the banks. In fact, to the contrary, most of them have been so conservative. HDFC was trying to manage its deposit, credit deposit ratio, so they really didn't have growth. Kotak has been more conservative on the side of caution. ICICI Axis had their own growth, but without any adventurous kind of loan lending that could be done. So that's what I was saying. The corporate loan side hasn't grown, but still NIMs have become significantly healthier, much healthier than expected because of the retail loan growth. And if consumption starts picking up, which is expected to do only because of the budgetary allocations and announcements that we had coming into effect somewhere in the end of first half FY26. I don't see any reason why corporate, as Asutosh was also saying, you could give them credit that they can expand the corporate book very rapidly as required, as more capex starts, downstreaming from the government's programs and all of that from the private sector too. So, all in all, I think we are set up in a very nice way. Good NIM improvement, credit growth is likely to be there, interest rates coming down, so your cost of deposits is also fairly benign. So all of that and a strong balance sheet, what else would you need? So I think the market will like these numbers and the allocations could probably be much more than 40% of the weightage that they otherwise carry. Financials have about 42% in the overall market, and the allocation is probably lesser than that in most portfolios. So that is something that would get reset.
All right. We also have with us Rahul Malani, the Deputy Vice President, Fundamental Research, Banking and NBFC Analyst at Sharekhan by BNP Paribas. Rahul, thanks very much for joining in here. What did you make of the ICICI Bank numbers? And going ahead, what are the sort of headwinds you'd be tracking?
So overall, I believe that on the NII front, with our estimates, the numbers are marginally higher. And on the operating front as well as the PAT front, the numbers are marginally higher due to the higher NII. We believe that marginal NIMs will not sustain in going forward because there was not pass on the lending rates. In going forward quarters coming, yields will be under pressure. So overall, partially, we will see that NIMs to be lower in going forward in the coming quarters. And on the loan growth front, we have seen marginal tepid growth this quarter. So overall, going forward, the loan growth will be tapped at equivalent to the deposit growth, because if you look at the average deposit growth for ICICI Bank, sequentially it has been at 2%. So overall, it is in line with the deposit growth. They will grow their loan book in line with the deposit growth.
All right, deposit trajectory, of course, and what happens to NIMs in the rates coming down scenario is something we'll watch out for all banks. Prakash, quick word on the kind of stock reaction you expect both for HDFC Bank and ICICI Bank come Monday.
Well, I think it should be positive for sure. HDFC still has a lot of disbelievers whether it will be able to catch up with the rest of the larger banks in terms of growth. But ICICI for sure has proven that in the past as well. So I don't think the market has got any doubts on that. So these numbers very clearly set up for the next few quarters to be promising. I do understand yields could be under pressure, but the corporate loan growth will probably take off much more significantly after maybe not the June quarter but September. So the market will be positively reacting to both these numbers for sure. More for ICICI than HDFC.
Well, Ashutosh, take a look at the ROA metrics of both the banks, HDFC Bank and ICICI Bank, what we have seen is that there is a sharp improvement in the cost to income ratio as well, which has meant that the operating efficiency has improved and credit cost is coming down. So do you expect the ROA to remain stickier on the higher side for the banking sector, especially the large banks?
Yes. Yeah, especially the large bank. So I expect FY26 to be very good for the large bank. As first half, we may see some hiccups here and there, but second half is going to be very good, where their deposit repricing and borrowing repricing will catch up by the second half, and that period is going to be very good for the bank, especially for all large private sector banks as well as large public sector banks who have a relatively higher proportion of CASA deposits.
Well, Prakash, one more question. What I've seen in the business momentum of the large lenders is that they are taking away market share because the industry is not growing as rapid as what numbers you are seeing for them with respect to deposit franchise. So especially when large banks are focusing on deposits and taking away the market share, will the money also move from small and mid-sized banks to large caps over the next couple of quarters?
So I don't have any empirical data that there's lots of money that's probably moved into these smaller banks. I feel, Abhishek, what's going to happen is the allocation to the sector as it grows will end up getting a bit skewed towards the order, as I said, is first large private sector banks, then it's large PSU banks. And when I say that, it'll probably be three which qualify, SBI, BOB, and maybe Can Bank. So after that, there's a whole tail of PSU banks which may not probably benefit out of allocations, but the private sector banks or the smaller private sector banks will probably see a lot of comeback. And see, all of them have carved out their niches. I mean, you have a federal bank which is SME focused, has a decent growth in its gold portfolio. You have a CSB doing the same thing in the south. So Karnataka Bank has its own agri-based kind of segment that it's growing into. So all of them will continue to grow, but the larger private sector banks will have a credit growth which will be matched with the deposit growth because they have to. If they keep raising money at lower cost, they can also lend at lower cost, remember? And that's where, it's the easiest to cherry pick good clients to borrow. And that's where, if that is going to happen, I think the allocation will continue to be skewed towards the larger sector bank, but it'll be fresh money that's coming in. I don't think there's too much of a shift that might happen.
All right, we'll leave it at that. Asutosh, Prakash and Rahul, all three of you, thank you very much for joining us here and helping us decode both ICICI Bank and HDFC Bank's fourth quarter numbers. Now, moving on, Yes Bank has also reported its fourth quarter numbers and they also beat estimates. Net profit rose by 63% over the previous year, but loan growth was the slowest that we've seen in at least the last 7 quarters. Abhishek Kothari is back with us to decode the earning fine print.
Well, control over cost of funds has actually helped the net interest margin and the PNL of Yes Bank in this quarter. So take a look at the PNL versus Apol. The NI is a beat of 4.3%, while the PAT beat is about 23.5%. Net interest margin is at 8-quarter high of 2.5%. The loan growth is very weak, one of the weakest that you are seeing in last 7 quarters, just 8.1% YOY and about 0.55% sequentially. The securities receipts are now nil, so basically they are now zero. Other income has also aided the top line growth for them. So other income is up 15% quarter on quarter, as fee income is up 21.5% on a sequential basis. So overall the loan growth was weak, but they made up in the fees. Fee income was very strong for them. So cost to income ratio hence is at the lowest in last 15 quarters, coming in at 67.3% versus 71.1% in the previous quarter, as OPEX has declined by more than 4% YOY. Annualized slippage ratio is at 10-quarter low, coming in at less than 2%, 1.99% versus 2.2% in the previous quarter. Net NPA ratio is one of the lowest that you are seeing in last 8 years or even more. Net NPA ratio is now down to 0.3% versus 0.5% in the previous quarter. Quarterly annualized credit cost is at 4-quarter high of 1.48% versus 1.26% in the previous quarter. Looks like there might have been a bit of write-off which got provisioning this time around. Return ratios, they are one of the best for the bank in last 25 quarters, but one of the weakest when you see with respect to peers performing, because return ratios continues to remain tepid when compared to peers, but one of the best in 25 quarters. ROA at 0.7% versus 0.6% in the previous quarter. ROE at 6.2% when compared to 5.2% in the previous quarter. Back to you.
All right. Thanks very much, Abhishek, for helping us decode all of those numbers. We have to take a short break on that note, but we'll be back with more on the other side. Stay tuned.